Welcome back, everyone, to my world of stocks, and welcome back to my new stock market weekly update series, where in each episode we take a look at how the stock market performed this past week. We cover any macro news that affected it either positively or negatively, and just for fun, we also do a quick rundown of which stocks made the biggest moves both up and down, and of course, I share my thoughts on all of the above. As always, I put timestamps for you down on the time bar, so if you do want to jump to any particular part of the video, you're more than welcome to. But we just had the second week of September wrap up here for trading. So with all of that said, let's go ahead and jump into this week's update. Okay, and starting first here with the markets, we know that the prior week was actually pretty strong. The three major indexes climbed by more than 2, 3, and 4% respectively. However, this past week was very different. There's still a little trading time left at the time of these screenshots. I'm actually going to post this video on Saturday, but I'm recording on Friday, so it's still a little early. But essentially, the Dow Jones is looking to finish almost 5% negative for the week, leaving it down more than 17% from its highs. The S&P 500 is down even more for the week at a negative 5.5% drop and is currently down over 20% from its highs, which is, considered a technical bear market. And then, as usual, the tech-heavy Nasdaq suffered the biggest losses of all, with over a 6% drop for the week, leaving it down by a giant amount from its highs at negative 30%, which is where we've seen a ton of tech stocks, just getting absolutely destroyed here in the Nasdaq, especially some of them losing like half their value or even more. Moving on to the market news, though, obviously this week was mostly negative news, and that's why we saw some big drops, especially on Tuesday, where the market saw its biggest declines, with the Nasdaq falling by over 5% just that day alone, and it was also the worst day for the Dow since June of 2020. And that had almost everything to do with our record high inflation that continues to rage on. See, our August report for the Consumer Price Index came out on Tuesday on that day, and it showed worse inflation than investors and analysts were expecting. Dow Jones economists were expecting a decline month over month of 0.1% for overall inflation, but it actually rose by that same amount month over month. And that's even with gas prices dropping sharply by over 10%, which is really bad news, by the way, because it essentially destroys the argument that so many people have been making, especially recently, that inflation is only happening because of Ukraine and the gas prices. But no, I mean, gas prices have been falling and inflation continues to rage on regardless. In fact, total inflation rose 8.3% in August, leaving us still right around a 4-decade high. And the reason why the market hated this news is because it crushed investors' hopes that inflation was finally cooling down and thus the Fed could ease up a little on interest rates. But that's not likely to happen now. And as such, the market is actually pricing in an even bigger increase during their next Fed meeting that is coming up on Tuesday than what was already a very high expectation of a third consecutive increase of 75 basis points. So they're expecting even more than that. And of course, rising inflation means that the cash companies are holding, is losing value, while rising interest rates are also making it more expensive to borrow money. Thus, that is why you're seeing so many stocks crash, especially the highly valued, more speculative ones. So throughout the week, investors were already on edge with a lot of pessimism on their minds, and it only made things worse when a few giant corporations came out and gave warnings about the economy and lingering supply chain disruptions caused by the pandemic. FedEx, for example, reported lower sales and earnings than expected and was even forced to withdraw their full-year guidance, citing macroeconomic headwinds, and their own CEO predicted that the global economy is heading towards a worldwide recession. Another example was General Electric, who also warned that lingering supply chain disruptions are going to impact their cash flow forecasts throughout the rest of the year, with China in particular being one of the causes thanks to their strict zero pepperoni policies. So you add all of that up, and yeah, it makes perfect sense why the market sold off by such a large amount this past week, as it definitely should have. There was a lot of negative news that came out. The prior week was a rally. You needed to see the market fall here. It did exactly what it should do. And I continue to believe this, and I told you guys this in last week's update video, that I think this coming year is going to remain extremely volatile, so you might want to buckle up. The economy is in not so great shape, but I also continue to believe that bear markets like the one that we're in right now, extreme volatility, even recessions, tend to be a long-term investor's best friend over the long term. When you zoom out and you end up looking at it, these are usually times where long-term investors are able to go in and be able to buy more shares than they typically might be able to. They can become larger investors of some of their favorite companies, and then when the next bull run starts, then they start to see the rewards of having accumulated all those shares and things like that. Obviously, you have to practice caution, you have to be strategic, you have to know what you're doing. I buy slowly in small amounts over time, but in the general sense, as a long-term investor, I welcome bear markets. It's not something that I'm typically afraid of. It's something that kind of excites me as a long-term investor. But anyway, with that said, let's go ahead and move on now, transition to the biggest gainers and losers of this past week. Let's take a look at some of those stocks, and then we'll wrap up the video right after that. Okay, so starting with the gainers first, I like to primarily look at the more popular large cap stocks since those have the greatest effect on the market and they're more commonly owned. And there's actually some pretty interesting ones here that we have for the week. But right at the top there, by far the best performer was AMTD Digital at over a 60% gain for the week, and that's actually a Chinese ADR stock. And what they do is they're like a one-stop digital solutions platform that helps customers with anything from financial services to media and marketing. But what's crazy though is that this is one heck of a volatile and honestly pretty shady type of stock too. I don't know if you guys have heard of this one, but first of all, this is a subsidiary of another company, which, by the way, was recently being investigated by Hong Kong securities regulators. But the new stock also just barely IPO'd back in July, where it proceeded to skyrocket to the moon to over $2,500 before crashing all the way back down to less than 100 this past week, where it proceeded to climb once again with a giant surge in trading volume on Wednesday that nobody has been able to explain yet, with trading on the stock even being halted several times. So I don't really know what to make of this, but it looks like day traders are having some fun with this one. It's definitely a crazy stock to keep track of. Other than that one though, the rest of the gainers were much more reasonable gains of around 10% or less, with some notable names including Store Capital, which is known for being the only real estate investment trust that Warren Buffett was invested in. But this past week, they actually agreed to an all-cash deal that will take them private, and that sent the stock climbing since the deal is for $32.25 per share, which is still just slightly higher than the current share price of $31.92. So still a little bit of profit, could potentially be had there if the deal gets approved. There was also a couple of speculative EV stocks that were up this week, including Lucid and NIO. I personally prefer NIO way more than Lucid. I think NIO, being a Chinese leader in premium EVs, sets them up really well for global expansion, which is exactly what they've been doing. They've been expanding very well. Make sure you check out some of my NIO videos if you want to learn more about that company and that stock. But we also saw some cruise lines rise, including Royal Caribbean and Norwegian Cruise, up close to 7% and 5% respectively for the week. And that had to do, almost entirely with cheaper travel overall. Not only did airplane ticket prices and gasoline prices both fall by around 10% in August, making it cheaper for travelers to be able to reach the cruise line ports before going on their voyages, but fuel oil also declined by over 5%, making it cheaper for these cruise lines to operate their business. I think fuel oil makes up like a fifth of all their operating expenses. So it's a pretty big deal when, the prices fall for that. And finally, the last stock I noticed here is DraftKings, which is the online sports betting company. And the reason I notice is because I've been thinking about doing a full review video on them because I think it's a pretty interesting company with very high revenue growth, but still some really heavy losses. So let me know down in the comment section if this is a stock that you would like me to do a review on. And if so, I'll make sure that I make a video for you guys on this one if enough people want to see it. Okay, finishing up here with the biggest losers. Well, of course you had FedEx fall by over 20% for the reasons I showed you earlier. And a lot of people actually like FedEx stock because online shopping is only going to grow larger over time, which is a pretty big tailwind for, a company like FedEx that does so much shipping and logistics and things like that. Obviously heavy in e-commerce. And because of the stock crash, their valuation is now like 20% cheaper than the sector, and the dividend yield is the second highest it's ever been for the company at around 2.5%. So, it might be an interesting stock to start looking into, especially if it keeps falling more. Besides that, though, we also saw some of the biggest paper and packaging companies take huge hits, including WestRock, International Paper, and Packaging Corp, all falling by over 15% for the week. And these are really interesting dividend stocks that you might want to start tracking if you're more of a dividend oriented investor, because from their 52-week highs, WestRock, IP, and Packaging Corp are each down more than 30%, leaving their dividend yields at 2.6%, 4.7%, and 3.8% respectively. Especially IP there. I mean, if they get up to above a 5% dividend yield, I mean, that could really start to look like a monster dividend there. I don't own any of these stocks myself, at least not yet, but IP is one that I do like to track on occasion. And finally, I just noticed here that a couple popular spec stocks also happen to crash, including Roblox and DoorDash, falling by 13% and 8% respectively. Now, Roblox, they make sense as it was actually one of the gainers that we noticed in last week's episode. So it looks like this was, a bit of a correction here, but fell, because of macro news and everything else. And I admit they're interesting with a video game that lets users create and play even more games within it. I think that's an interesting concept, and it's led to huge popularity with over 50 million daily users this year and super high revenue growth. It's very popular, especially among young people, and kids and things like that. But this is a company that continues to lose more and more money every year. So, given the current macro environment, their stock is just getting crushed at the moment. Also, seems a little risky to me to invest in a company like this that is, essentially basing their entire business around a single video game, even if it can create other games within it. It's still something to maybe be cautious with. But DoorDash was the other one here, and they're pretty similar. I mean, they too continue to get crushed, leaving them down over 60% year to date. And they also have that one part to their business that is in a growingly more competitive market, delivering food and groceries and stuff like that. So at the same time, they're also losing billions of dollars every year, and they consistently miss on earnings. So I don't know. It's a spec stock. I'm not particularly interested in it myself. But anyway, I think that's going to just about do it for this week's update video. I hope you guys enjoyed it. What are your thoughts? Any thoughts you want to share? Any stocks? Any macro news? Anything you want to talk about? Let me know down in the comment section. Love to hear your thoughts. And I hope you're all doing well. And I will catch you in the next one. Take care. Bye-bye.